Have you ever looked at a company's financial report and seen what looks like pretty bad news, but then watched its stock price actually climb?
Yeah, it happens. It's kind of a paradox, isn't it?
It really is, and often it signals something much bigger, maybe a bold move happening behind the scenes. Welcome, everyone, to the Deep Dive. Here, we take, a whole stack of sources, articles, research data, our own notes, and we really try to pull out the most important bits of knowledge and insight. We want to give you a shortcut to being genuinely well-informed.
Hmm.
So today, we're diving into Navitas Semiconductor's second quarter 2025 earnings. And our mission for this deep dive is to figure out that exact puzzle. Why would a company's stock go up when the main financial numbers seem, well, weak? We'll do that by looking closely at a really crucial strategic pivot they're making.
And we've got some solid material to work with here. The main source is Navitas' official Q2 2025 earnings press release, but we've layered in verified real-time market data and quite a bit of analyst sentiment to give you the full context. We're going to use a structured 5-part framework to walk you through it. It helps break down not just what happened, but maybe more importantly, why it happened.
Okay, great. So get ready. This should be a pretty fascinating look at financials, strategy, and a company basically making a calculated sacrifice now for what they hope is a much, much bigger payoff down the road.
Right, so to really get into this paradox, let's start with our first section, slide 1, the at-a-glance scorecard. The immediate puzzle here is pretty stark. Navitas Semiconductor, their Q2 was all about this big strategic shift into the AI data center market, hot area, obviously.
Right.
But the financial headlines, they screamed weakness, yet the stock actually edged up. How does it even work? That's the million-dollar question, isn't it?
Yes.
And yeah, the surface numbers, they definitely paint a challenging picture. Total revenue for Q2 2025, $14.5 million. Now, compare that to $20.5 million for the same time last year.
Oof.
Yeah, that's a pretty significant year-over-year drop, 29.2%.
Right.
And the GAAP net loss, that got worse too. It went from $22.3 million to, a substantial $49.1 million loss.
Okay.
Which translates to a GAAP diluted loss per share of 25 cents. So not great on the surface. But, and this is a big but, this is where things get more interesting and why analysts often look beyond just the GAAP numbers. On an adjusted non-GAAP basis, which, strips out certain things like non-cash charges or one-off items to try and show core performance, the company reported a diluted loss per share of just $5.
Ah, okay. Much smaller loss there.
Exactly. And what's really key here is that this was actually an improvement compared to the $7 loss per share in Q2 of 2024. And crucially, it met market expectations bang on.
Okay, wait. So here's where it gets really interesting then. Despite that big revenue drop and the ugly GAAP loss, the stock actually climbed something like 3 to 5% right after the release.
That's right. In immediate post-release trading.
So what did the market see that the headlines didn't? You mentioned analyst sentiment.
Yeah, the initial analyst takes focus almost entirely on the company's long-term pivot, this big strategic move into AI data centers. They basically saw that narrative as way more important than the weak short-term financials.
It's like the market was saying, okay, we see the near-term pain, but we like the long-term plan.
Precisely. And what's fascinating is that divergence. You've got revenue down nearly 30%, but the non-GAAP EPS actually improving. It really points to disciplined operational management. They were controlling costs even while navigating this big shift.
So they tightened their belts effectively.
It seems like it.
Okay.
Even with less money coming in, they managed to shrink that adjusted loss per share by over 28%, mainly through cost control. Now we should also mention diluted EPS briefly. It's basically the most conservative way to look at earnings per share, because it includes all the shares that could potentially exist, like from stock options.
Okay.
And this quarter, that non-GAAP improvement per share was slightly offset or muted because they recently raised capital, which means more shares outstanding. The number went up from about 183 million to 199 million shares.
Right, so the pie got sliced into more pieces, affecting the per-share number.
Exactly. It shows that balancing act between funding growth and managing dilution for existing shareholders.
So what does this all mean? What's the big picture takeaway from this first slide?
Well, it tells us the market essentially looked right past the current weak numbers. It focused instead on that strategic pivot towards the super high-growth AI market.
And that pivot had credibility.
It seems so. It was validated by that key partnership they announced with NVIDIA, and it was funded by a fresh $100 million capital raise.
So it wasn't just talk.
Right. This isn't just some random stock blip. It's a signal that At least right now, the market can value these big, bold bets on future tech over immediate financial performance if they're backed by credible partners and, solid funding.
It's the market betting on the future potential, not just the present reality. A really key distinction. Okay, we've seen the market's reaction. But how exactly did Navitas manage that non-GAAP improvement when revenue was falling so much? Let's go under the hood now with slide 2, the engine of profitability. This should tell us about their operational efficiency.
Absolutely. And a big part of the answer lies in that significant gap between their GAAP and non-GAAP gross margins.
Yeah, you mentioned GAAP was negative.
Right. GAAP gross margin was negative 11.8%, which, looks pretty bad on its own. But the non-GAAP gross margin, that was a healthy 38.5%. And that's pretty close to the 40.3% they had last year.
Wow, that's a huge difference. What explains that gap?
It comes down to 3 main adjustments management makes to get to that non-GAAP number to show what they see as the underlying profitability. First, there's something called amortization of intangible assets. That was $4.0 million. Think of it like spreading out the cost of something they acquired in the past, like a patent or brand name, over time. It's an accounting expense, not actual cash going out the door related to current sales.
Okay, a non-cash charge.
Exactly. Second, they had a specific China second inventory reserve of $3.2 million. This sounds like a one-time write-down for some silicon carbide inventory in China, not something expected to happen every quarter.
Got it. Specific issue.
And third, a smaller adjustment for stock-based compensation, about $0.1 million. That's another non-cash charge related to employee stock options that analysts often exclude when comparing core operational results between companies.
So these adjustments paint a very different picture of the underlying health. What stands out to you here?
Well, what's really striking is how it connects to the bigger picture of operational efficiency. Even with that $6 million year-over-year drop in revenue, Navitas' non-GAAP loss from operations actually got smaller. It shrank to $10.6 million from $13.3 million a year ago.
Interesting. So lower revenue, but also a lower operating loss on that adjusted basis.
Precisely. It really demonstrates significant operational discipline, tight cost management, right in the middle of this big strategic shuffle.
And management seems confident they can keep that up.
Yeah, they actually claimed they can ramp up investment in AI without an increase in near-term operating expenses. And the guidance supports that. Their Q3 forecast for non-GAAP operating expenses is about $15.5 million, which is actually down from $16.1 million in Q2.
So the takeaway here is this improvement in efficiency, even while they're intentionally shrinking revenue in some areas, is a really crucial signal.
I think so. It shows they're managing their cash burn carefully. That builds credibility for their long-term AI strategy.
And it suggests maybe a leaner operation when that AI growth hopefully kicks in.
Potentially, yeah. It could accelerate their goal of hitting positive EBITDA, which they've targeted for 2026.
Okay, that makes sense. Now let's dig into the why behind these changes. Let's move to slide 3. The engine room business segment performance. This is where we get to the heart of the strategic shift itself.
Right. And while the company doesn't give us, exact dollar breakdowns for each business segment in the release.
Which is pretty common, unfortunately.
It is. But the commentary from management makes it crystal clear. This wasn't just a market downturn. It was a very deliberate, significant strategic shift. They are actively pulling back from some established markets to pour resources into the emerging AI sector.
So focusing their bets, what's the new core focus then?
They call it the new core, AI data centers and energy infrastructure. And the absolute biggest piece of news here, the real validation point that got the market excited, is a development collaboration with NVIDIA.
Okay, NVIDIA.
Yeah.
That's obviously a huge name in AI.
Exactly. They're working with NVIDIA to support its next-generation 800-volt data center architecture. This gives Navitas a really crucial connection, a foothold, with the dominant player in AI compute right now.
And the market potential there is big.
Potentially massive. Management estimates it could be a $2.6 billion addressable market for them by 2030, just across 3 key power conversion stages within these advanced data centers.
$2.6 billion. That's a huge number.
Yeah.
But there's a catch, right? A timeline.
There is. And it's important to keep this in perspective. Engineering samples are expected late 2025, so still a way off. And actual volume production, that's not anticipated until 2027.
2027. So this is definitely a long-term play.
Very much so.
So if they're focusing heavily on AI, what does that mean for their existing markets, the ones they're moving away from?
Right. So those are what we can call the de-emphasized markets, primarily mobile, consumer electronics, and appliances. Navitas is actively reducing its dependence here. They said they'll now only selectively serve and lead the high-end premium segments. They did mention a win with Xiaomi for a new fast charger as an example.
So focusing on the fancy stuff, maybe higher margin.
That seems to be the idea. But fundamentally, it signals a retreat from the broader, maybe more commoditized parts of those markets where they used to play.
And this directly impacts the near-term financials we saw earlier.
Absolutely. This strategic shift is the main reason for that weak near-term financial outlook. Management explicitly connected their Q3 revenue guidance, which is only $10 million, directly to this more selective mobile strategy.
So they basically chose to have lower revenue right now.
Yes. It's a self-inflicted revenue decline, but for strategic purposes, they're sacrificing current sales to invest in that future AI prize.
You know, this raises a really important point. This strategy feels inherently high risk, high reward. Navitas is willingly shrinking its revenue base.
It's a bold move.
If that AI bet gets delayed, or if it doesn't pan out quite as big as they hope, couldn't they be left in a much weaker spot, having given up ground elsewhere?
That's the risk, absolutely. If the AI ramp takes longer, or competition is fiercer than expected, or the market shifts, yeah, they could find themselves having shrunk their present for a future that doesn't fully materialize.
It really frames investing in Navitas today less like a traditional semiconductor play and more like a venture capital style bet on a specific long-term tech trend.
That's a pretty good way to put it, I think. You're betting on the trend and on this specific team's ability to capture a big piece of it, even with that long runway and inherent uncertainty.
Okay, so a big bet needs big funding. Let's pivot to slide 4. Financial strength and shareholder rewards. A major strategic shift like this needs serious financial muscle. How is Navitas actually bankrolling this ambitious AI plan, especially with revenue dipping in the short term?
Right, you can't make a multi-year bet like this without the cash to back it up, and they've definitely taken steps to strengthen their balance sheet significantly. As of June 30th, 2025, Navitas reported cash and cash equivalents of $161.2 million.
Okay, $161 million. How does that compare to before?
It's a huge jump from the $86.7 million they had at the end of 2024, almost double.
Wow. Where did that extra cash come from?
It came from that capital raise we mentioned earlier. They recently sold about 20 million new common shares, which generated $97 million in net proceeds after fees.
Okay, nearly a $100 million injection.
Exactly. And management was very clear about what this money is for. They explicitly earmarked it to support our development and growth expectations, primarily for AI data centers and related energy infrastructure markets. So it's directly funding the pivot.
That makes sense. What about debt? Are they taking on loans too?
That's another interesting point. Their leverage is actually remarkably low.
Yeah.
If you look at their total liabilities versus their stockholders' equity, the debt-to-equity ratio is only about 0.16.
0.16. That's tiny.
It really is. They operate on a virtually debt-free basis. And that's a significant strength, especially when you're in a heavy investment phase with negative cash flow, like they are now. They aren't burdened by big interest payments while trying to innovate.
Okay, very little debt, lots of new cash.
Yeah.
But issuing 20 million new shares, that infusion of capital definitely comes at a cost for existing shareholders, right? You touched on dilution earlier.
Yes, absolutely. And it's a crucial point for anyone already holding the stock or thinking about it. When a company issues new stock, each existing share represents a smaller slice of the ownership pie. Like you said earlier, the pie gets bigger, but your individual slice doesn't, so its relative size shrinks.
Right.
We saw the weighted average number of basic shares outstanding grew by 8.7% year over year, up to 199 million. That directly impacts calculations like loss per share.
And because they're a growth company, they're not returning cash through dividends or buybacks.
Correct. They're reinvesting everything they can into growth. So this capital raise is essentially them asking the market for more investment to fund that future AI vision, betting that the eventual pie will be much, much larger.
So what's the bottom line here on the financial strength? This $100 million raise, it seems like it can be viewed almost as a strategic bridge.
That's a perfect way to think about it. It's bridging that gap, that valley of death you sometimes hear about, created by shifting from current revenue streams to future ones. A quick back-of-the-envelope calculation shows their previous cash balance might have lasted them maybe 2 years at their current burn rate.
Okay.
This new $161 million extends that runway to well over 3 years, and that comfortably gets them past their 2027 target for starting AI volume production.
So it buys them the time they need to execute the plan.
Exactly. If we connect this to the bigger picture, it was a preemptive and I'd say critical move. It significantly de-risks the transition. It sends a strong signal not just to the market, but also to partners like NVIDIA, that Navitas has the financial stamina, the staying power to see this long-term AI strategy through.
It turns the AI pivot from maybe just a risky bet into a fully funded multi-year strategic initiative.
Well put. It shows they're not just hoping it works out, they've secured the funding to make it happen.
All right, makes sense. So finally, let's move to our last section, slide 5. The road ahead management's outlook and key takeaways. What's the official view from the company itself about the path forward? And what are the absolute must-know takeaways from this whole analysis?
Okay, so Navitas provided official guidance for the third quarter of 2025, and it really reflects that near-term financial impact of the pivot we've been discussing. They expect net revenues of $10.0 million plus or minus $500,000. That's that selective mobile strategy showing up right there in the numbers.
Yeah, that's quite a drop from Q2's $14.5 million.
It is. But on the other hand, they expect non-GAAP gross margin to hold steady around 38.5% plus or minus 0.5%, which is consistent with Q2.
So maintaining profitability on the products they are selling.
Seems so. And non-GAAP operating expenses are expected to be around $15.5 million, which, as we noted, is slightly down from Q2, showing continued cost discipline.
Okay, so the guidance matches the strategy narrative. What about the qualitative stuff? How did the CEO frame this?
Yeah, I think CEO Gene Sheridan's quote here is pretty insightful. He said, and I'm quoting, "We were successful in creating an all-new market for GaN mobile chargers over the past 5 years, and now we intend to create an even bigger new market encompassing both GaN and SiGe for AI data centers and related critically needed energy infrastructure."
Even bigger new market. That's quite a statement of ambition.
It really is. It signals they believe this AI opportunity dwarfs even their previous success in basically creating the market for GaN fast chargers.
Yep.
They're aiming very high.
Okay, let's wrap this up then. Let's crystallize the key takeaways from this entire deep dive into the Navitas' quarter. If someone remembers only a few things, what should they be?
All right, I think there are 3 core takeaways that really capture the essence of this quarter for Navitas, pulled directly from the source material. First, a calculated sacrifice. Navitas is intentionally taking a big hit on near-term revenue. That 29.2% YoY drop in Q2, the weak Q3 guidance, that's not an accident. It's a direct result of their strategic choice to pivot hard into AI and pull back from lower-end markets. It's painful now, but deliberate.
Got it. Sacrifice for strategy. What's number 2?
Second, the fortified war chest. That roughly $100 million capital raise, even though it dilutes shareholders a bit, was absolutely vital. It de-risks the whole long-term strategy by giving them a cash runway that lasts well beyond their 2027 AI production target. It ensures they have the fuel to execute.
Okay, funded the plan. And the third takeaway?
And third, the market's forward-looking verdict. The positive stock reaction, despite the weak headline numbers, shows investors are doing exactly what Navitas hoped. They're looking across the valley. They're valuing Navitas not just on these Q2 results, but on the credibility of that future AI story, a story made much stronger by the NVIDIA partnership and that fresh funding. It's a vote of confidence in the long game.
Right, so putting it all together, this quarter for Navitas wasn't really about a simple beat or miss on earnings per share.
Not at all.
It was fundamentally about strategic sacrifice, about disciplined repositioning, and about successfully convincing the market, at least for now, that the long-term promise of their AI strategy is worth the short-term pain and uncertainty.
Yeah.
It's a really bold gamble.
A very bold gamble.
And it makes you think, doesn't it? This whole deep dive into Navitas kind of challenges us to consider how we evaluate companies. What does it mean for you as an investor or just an observer when a company bets its whole present on a future that's still years away? And what signals should you really be looking for to judge if that kind of huge calculated risk is actually starting to pay off? Something to chew on.
Definitely. And just before we wrap up, the standard reminders. Please remember, this report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. Any investment decisions should always be made based on your own research and ideally in consultation with a qualified financial professional. Also, it's important to note that this report was generated using an artificial intelligence model. While it's designed to stick closely to strict data sourcing, errors or omissions might still occur. So please, all information, including any financial data or calculations discussed, should be independently verified by you before making any decisions based on it.
Like and subscribe to stockanalytics.ai. YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.